If your salary doubled tomorrow, would you truly become rich? Or would you simply raise your standard of living and remain dependent on the next paycheck? This question may seem simple, but it reveals a deep divide between two mindsets, those who consume the present and those who build the future. And this difference doesn't show up only in individuals. It becomes very clear when we look at countries. There are nations that receive billions in resources and remain fragile. And there are others that start with virtually nothing and build lasting prosperity for generations. Today you're going to understand how wealthy countries think in the long term, and, more importantly, what you can immediately apply to your own financial life. Sustainable wealth is not born from luck, nor simply from high salaries, and certainly not from isolated opportunities. It comes from strategy, discipline, and a vision that spans decades. So if you want to develop a mindset that truly builds wealth, withstands crises, and grows over time, make sure to subscribe to the channel and watch this video until the end. What you're about to learn here isn't motivational theory, it's a mental framework applied by entire nations. The difference between fragility and prosperity almost never appears dramatically at the beginning. It doesn't emerge as a major event, but as a subtle shift in trajectory. Small financial decisions, repeated over time, create invisible trends. Spending a little more than you should, postponing investments, ignoring reserves, taking on unnecessary debt, all of this seems harmless in the short term. But the cumulative effect of these choices builds either a fragile or a solid foundation. Prosperity is, above all, a phenomenon of consistency. Countries that have achieved sustainable wealth understand that growth is not a peak, it is a process. They create policies that outlast governments, election cycles, and external crises. They maintain strategic direction even when immediate results are not spectacular. This continuity generates predictability, and predictability enables planning. Planning, in turn, reduces risks and amplifies opportunities. Time is the primary multiplier of this process. In the short term, prudent decisions may seem overly conservative. Saving instead of consuming, investing instead of showing off, studying instead of simply working more hours, all of this requires immediate sacrifice. But over the long term, discipline turns into a competitive advantage. What once seemed small begins to scale. What seemed slow begins to accelerate. What felt irrelevant starts to create structural impact. On an individual level, this mindset requires emotional maturity. It means understanding that not every opportunity needs to be seized, that not every increase in income must translate into a higher standard of living, and that stability is not a lack of ambition, it is the foundation for sustainable growth. It means building margin before pursuing expansion. It means accepting that financial freedom is the result of strategic accumulation, not momentary impulses. In the end, the central question is not whether you have access to the same resources as a developed nation, but whether you are willing to operate with the same long-term logic. True wealth is not an isolated event nor the result of a single big decision. It is the inevitable product of consistent planning, fiscal discipline, intelligent investment, and strategic patience. Countries that prosper are not those that consume more in the present, but those that build more for the future, and that is a choice you can start making today. This story reveals a structural principle that is often overlooked. Wealth is not born merely from the existence of resources, but from the ability to manage them intelligently over time. Resources are potential. Management is transformation. Without strategy, even abundance dissipates. With strategy, even scarcity can be converted into sustainable growth. What determines the final outcome is not the starting point, but the management model adopted. This reasoning does not apply only to countries or large institutions. It is deeply personal. Every paycheck you receive, every bonus, every opportunity for extra income represents a resource that can either be consumed or converted into an asset. The central question shifts from "how much do I earn?" to "how do I structure what I earn?" Thinking this way requires expanding your time horizon and moving away from the short-term logic that dominates much of individual financial decision-making. When you decide between spending and investing, you are not merely choosing between two momentary alternatives. You are defining the architecture of your future. Decisions oriented toward the short term relieve immediate pressures and generate quick comfort. Decisions oriented toward the long term build autonomy, margin, and resilience. This difference in mindset, repeated over the years, creates completely distinct trajectories. Norway offers a concrete example of this strategic choice. When oil revenues began flowing in at multi-billion-dollar levels, the country had every condition to rapidly expand public spending, stimulate domestic consumption, and quickly raise the population's standard of living. This path is common in economies that discover abundant natural resources. The feeling of immediate prosperity creates excessive confidence and reduces the sense of urgency for structural planning. This behavior is so recurrent that it has been given a name in economics: the resource curse. Countries rich in commodities often experience cycles of euphoria followed by instability, precisely because they turn extraordinary revenue into permanent increases in spending. When commodity prices fall or production declines, the structure built on that revenue enters into crisis. Abundance, without discipline, becomes fragility. Norway broke this pattern by creating the Government Pension Fund Global, a sovereign wealth fund designed to invest oil revenues in diversified global assets. The logic behind this decision was strategic. Oil is a finite resource and subject to volatility, but stakes in global companies, real estate, and international bonds can generate continuous returns for an indefinite period. By converting a temporary flow of wealth into a permanent portfolio of productive assets, the country transformed a specific economic cycle into intergenerational stability, ensuring that present prosperity does not compromise the future. Now bring this logic into your own life. Your income is not infinite. Your productive time is limited. Your physical and mental energy have an expiration date. Just like oil for Norway, your ability to generate income is a resource that must be managed intelligently. If you consume everything you earn during your most productive years, you are essentially converting a finite resource into temporary comfort, without building any foundation for the future. Investing part of your income regularly is the equivalent of creating a personal sovereign wealth fund. It's not just about accumulating money, but about transforming active income, which depends on your daily effort, into assets that generate passive income. This transition is strategic. While you work for money, it depends on your presence. When you build assets, part of that money begins to work for you. The difference between financial fragility and stability is born from this gradual shift from effort to ownership. Wealthy countries understand that every strategic surplus must be converted into a productive asset. Surpluses are not treated as a license for permanent expansion of consumption, but as an opportunity for structural strengthening. During periods of above-average growth, they build reserves, reduce vulnerabilities, and expand long-term investments. This discipline creates buffers against future crises and allows for strategic continuity even in adverse scenarios. In personal life, however, the pattern is often the opposite. Extraordinary gains are frequently absorbed by an immediate increase in lifestyle. A bonus turns into a trip, a salary raise turns into a new loan, extra income turns into recurring consumption. The problem is not in enjoying achievements, but in turning one-time gains into permanent commitments. When extraordinary income becomes a fixed expense, your margin disappears. And without margin, there is no capacity for consistent investment. This is where fiscal discipline comes into play, one of the pillars of the world's most stable economies. Singapore, for example, built its international credibility by maintaining strict budgetary rules and accumulating substantial reserves over time. It does not operate systematically at the limit. This stance creates predictability, and predictability builds confidence, both internally and externally. In personal life, fiscal discipline serves exactly the same function. Living below what you earn creates margin. Margin allows investment. Investment generates accumulation. And accumulation, over time, turns into true financial freedom. Stability is rarely the result of chance. It is built through anticipation and structure. Economically solid countries do not operate under the assumption that the current scenario will last forever. They start from the premise that shocks are inevitable. Global recessions, financial crises, geopolitical conflicts, pandemics, and technological disruptions are part of historical dynamics. The difference is that prepared economies absorb the impact without collapsing because they built buffers before the turbulence arrived. These buffers are strategic reserves. They do not exist for comfortable times, but for adverse scenarios. By accumulating surpluses during favorable periods, countries reduce the need for desperate decisions during crises. This prevents abrupt cuts, excessive debt, and loss of credibility. A reserve does not stop the storm, but it prevents the storm from destroying the entire structure that was built. In personal life, the logic is identical. An emergency fund does not eliminate layoffs, health issues, or unexpected family expenses. What it does is prevent an unforeseen event from turning into chronic debt or prolonged financial disorganization. Without reserves, any shock becomes an emergency. With reserves, the same shock becomes a manageable problem. That difference completely changes your level of stress, autonomy, and decision-making capacity. There is an even deeper factor at play: time horizon. The ability to think beyond the immediate present is a powerful psychological skill. Studies in behavioral economics show that individuals who can delay gratification tend to build more wealth over the course of their lives. The same pattern appears in nations. Governments that prioritize instant popularity often adopt measures that provide temporary relief but create long-term structural costs. In contrast, countries that tolerate unpopular decisions in the short term tend to reap lasting stability in the long run. At the individual level, this battle takes place every single day, quietly. Each choice between consuming now or investing, raising your lifestyle or expanding your net worth, seeking immediate validation or building future security, shapes your financial trajectory over the years. On their own, these decisions seem small. But accumulated over time, they create radically different outcomes, one marked by constant dependence on the next paycheck, the other sustained by autonomy built with intention and discipline. Another decisive factor in the development of any economy is investment in human capital. Singapore understood very early on that its true wealth was not in land or natural resources, but in the qualification of its population. By directing efforts toward high-level technical education, competitive universities, and professional training aligned with global demands, the country drastically increased its average productivity. This created an environment capable of attracting multinational companies, fostering innovation, and sustaining long-term growth. At the individual level, the principle is exactly the same. Your main asset is not your car, your house, or even your financial investments. It is your ability to generate income. Technical skills, strategic thinking, communication, emotional intelligence, and adaptability determine your lifetime cash flow potential. When you invest in knowledge and scarce, high-value skills, you increase your market value. And assets that generate consistent cash flow are the foundation of any solid wealth-building strategy. But human capital does not operate in isolation. It is amplified by reputation. Wealthy countries understand that institutional stability, regulatory predictability, and transparency create trust. Global investors allocate capital where the rules are clear and do not change arbitrarily. Institutional reputation reduces perceived risk, and lower risk attracts more capital. This creates a virtuous cycle of growth and credibility. Individuals also build, or destroy, their reputations over time. Reliability, consistent delivery, professional ethics, and technical competence function as an invisible yet extremely valuable asset. People with a strong reputation receive more opportunities, participate in strategic projects, and gain access to higher quality networks. Over the years, that credibility acts as leverage, amplifying earnings potential and accelerating career growth. Finally, there is a silent element that connects all of this: consistent accumulation. Prosperous countries do not rely on spectacular moves or isolated extraordinary cycles. They execute structural strategies with discipline over decades. Norway's wealth did not emerge merely from a period of high oil prices, but from continuous contributions and systematic reinvestment through its sovereign wealth fund. This is the logic of compound interest applied on a national scale. In the beginning, the results may seem modest. Over time, growth accelerates, the base expands, and the cumulative effect transforms consistency into exponential progress. The greatest challenge is that the most powerful phase of wealth building is invisible at the beginning. In the early years, the results seem too modest to justify the effort. Progress feels slow, almost imperceptible, and that often creates frustration. Many people give up precisely at this initial stage, before compound interest has had enough time to reveal its true strength. They mistake subtle progress for the absence of progress. Exponential logic demands strategic patience. Compound interest does not reward momentary intensity, but sustained consistency. A single bad year does not invalidate a solid strategy, just as one exceptional year does not guarantee permanent prosperity. Economically mature countries understand this. They do not completely overhaul their structural policies with every short-term fluctuation. Instead, they They maintain clear long-term guidelines and adjust execution when necessary, without abandoning the core plan. Thinking like a prosperous nation means internalizing a decades-long perspective. Prosperity is not the result of isolated, spectacular decisions, but of the disciplined repetition of intelligent choices over time. It means transforming active income into productive assets, converting surpluses into wealth, and building reserves before necessity arises. It is about replacing impulses with strategy and exchanging emotional urgency for structural coherence. This mindset also requires the maturity to distinguish between immediate pleasure and future freedom. Consumption delivers instant satisfaction, but it rarely creates autonomy. Assets, on the other hand, demand sacrifice in the present while expanding possibilities in the future. The decision between spending and investing is not merely financial, it is philosophical. It defines whether you are prioritizing momentary comfort or long-term freedom of choice throughout your life. When you begin to see your own life as a small economy, everything becomes clearer. You have income, expenses, assets, liabilities, human capital, and reputation. You can operate constantly at the limit or create strategic margin. You can react to every external stimulus or establish a long-term personal policy. Just like a country, your financial destiny is not determined by a single event, but by the structure you build and the consistency with which you sustain it over the years. The line that separates fragility from prosperity almost never appears as a dramatic event. It begins subtly, almost invisibly, built through the daily repetition of small decisions. An extra expense here, a postponed investment there, a strategic choice maintained even without immediate recognition. At first, nothing seems decisive. But over time, small directions turn into completely different destinies. Countries that have achieved sustainable wealth understood that time is not just a factor, it is their primary asset. They use the long term as a competitive advantage. They recognize that accumulated discipline outperforms momentary impulse. While the short term rewards popularity and immediate comfort, the long term rewards consistency, structure, and strategic vision. It is a silent difference, but a structural one. When we bring this into personal life, the question shifts from the quantity of resources to the quality of mindset. It doesn't matter whether you started with little or a lot. What truly matters is whether you are willing to operate with a builder's logic rather than a consumer's logic. Lasting wealth is not born from a single great decision, but from a continuous process of choices aligned with a broader plan. Consistent planning, fiscal discipline, strategic investment, and patience are not abstract concepts. They are repeated behaviors. They are choices made even when no one is watching. They are temporary sacrifices exchanged for future freedom. And that is precisely what separates those who remain forever dependent on their next paycheck from those who build true financial autonomy. If this kind of mindset makes sense to you, then go ahead and like this video and subscribe to the channel. Because here, we don't just talk about making money, we talk about building structure, vision, and long-term freedom. Countries that truly prosper are not the ones that consume more today, but the ones that build more for tomorrow. And you can start doing exactly that right now.